In the traditional stock market, retail traders operate under strict limitations. You are bound by the pattern day trader rule, requiring a minimum account balance just to trade actively, and you wait 2 full days for your cash to settle after closing a position. The futures market operates under a completely different set of physics. Here, high leverage and instant execution are the baseline rules of engagement. When you trade futures, you aren't buying a fractional slice of a company. You are entering into a binding agreement to buy or sell a specific asset at a predetermined date in the future. The CME Group designs these contracts with 3 rigid parameters: the exact underlying asset, the minimum allowable price movement, known as the tick size, and the specific expiration date. Because every single trader agrees to these identical terms, the market can match buyers and sellers at high speed. Millions of contracts change hands daily without anyone worrying if the person on the other side can fulfill their end of the bargain. When you open a futures trade, you post a performance deposit called margin. This allows you to control a massive amount of an underlying asset with only a tiny fraction of the capital, a concept known as notional value. Let's look at the S&P 500 index. You can trade the standard E-mini S&P 500 contract, known by the ticker ES, or you can trade its smaller counterpart, the micro E-mini, the MES. The math scales directly. With the standard E-mini, every single point the S&P 500 moves changes your account balance by $50. The micro E-mini is exactly 1/10 the size, shifting your balance by just $5 per point. That reduced tick value means the broker requires far less margin to hold an open position. The micro E-mini acts as the ideal training ground. It lets newer traders execute real strategies and gain live screen time without the risk of wiping out their entire account on a single bad read. If you buy a stock and the price drops, your losses only exist on paper until you finally decide to sell. Futures require a strict daily accounting of your cash. This is handled through a process called mark-to-market. At the closing bell every single day, the exchange updates your open positions, instantly crediting profits or deducting losses directly from your account balance. To step onto the field and open one standard ES contract, your broker requires an initial margin deposit. Depending on market volatility, that entry ticket sits around $13,200. Below that initial deposit sits a strict floor called the maintenance margin. This is an absolute red line drawn by the exchange, typically set at 70 to 85% of your initial margin. Your equity cannot cross this line. Let's say you buy a contract and the market drops 50 points against you. That is a $2,500 unrealized loss. Your account takes a severe hit, but because your equity remains above that maintenance line, your position stays open. But if the market drops 80 points, your equity breaches the maintenance floor. This triggers an immediate margin call. The broker halts your trading, and you must deposit funds instantly, or they will liquidate your position to cover the risk. In this market, you cannot sit and hope a losing trade turns around. Breaching maintenance margin strips away your agency and hands total control of your account over to the broker. Because margin limits are mathematically unforgiving, you have to read the market's defensive structure before you execute a trade. This diagram shows a candlestick formation known as a swing low. A central low candle bracketed by higher lows on either side reveals exactly where buyers stepped in, establishing real-time market support. On the right side, a swing high occurs when a central high candle is surrounded by lower highs. This clearly signals heavy market resistance where sellers took control of the price. Identifying these specific swing points allows you to place incredibly precise entries and tight stop losses. Defining your risk down to the exact tick is the only reliable way to survive the brutal math of maintenance margin. A share of stock can sit in your portfolio for decades. Futures contracts have a shot clock. Every contract has a hard expiration date, usually landing on the 3rd Friday of the contract month. If you fail to exit your position before that clock runs out, the contract is forced into final settlement. For equity indexes, this means a cash settlement. The exchange calculates the final closing value of the index and permanently debits or credits your account based on where the price landed. To avoid settlement, traders use a method called offsetting. If you are holding one long contract, you simply execute an equal and opposite transaction, selling one short contract. The two positions cancel each other out, neutralizing your trade before expiration. Institutions use a technique called rollover. They simultaneously close their expiring front-month contract and buy the next month's contract. This allows them to maintain their long-term macro position without holding an expired asset. Futures contracts provide unmatched leverage and execution speed, but taking advantage of those mechanics requires strict discipline, absolute control over your margin, and constant awareness of the clock.